Hello and welcome to AI Market News by LMM. Today, we are focusing on a massive question hanging over the financial world right now. Is an AI stock market crash looming? Are we literally in an AI bubble? Well, let's dive right into this and explore whether the absolutely massive momentum behind artificial intelligence stocks is finally hitting a wall. We're seeing some rapid shifts in macroeconomic conditions that could be signaling a major turning point for us.
So the absolutely crucial question we need to ask ourselves is this: is the AI bubble finally bursting? We are currently tracking some serious headwinds. For months, AI infrastructure and tech have driven this almost unstoppable equity rally. But now, shifting global conditions, specifically surging bond yields and geopolitical anxiety, are throwing massive hurdles in our way. We really have to wonder if the momentum that brought us here is finally running out of steam.
And we are already seeing the immediate impact of this anxiety today. Based on the prepared resources, looking at the US equity markets, we can clearly spot a noticeable softness and a very specific tech sell-off. The S&P 500 is down around 0.18%, while the tech-heavy NASDAQ is taking a harder hit, down roughly 0.51%. The Dow Jones Industrial Average is kind of fluctuating, managing a slight gain of just under 1/3%. But the broader picture? It shows clear market anxiety, particularly for those high-flying technology and semiconductor assets. Adding fuel to this fire is a stark warning coming straight from Morgan Stanley. Mike Wilson's team recently released a report pointing out that the ongoing global bond sell-off is directly undermining the AI-driven stock rally. They warn that if long-term interest rates continue to climb and bond market volatility remains high, we could literally be looking at the first substantial, broad-based equity correction since the market bottomed out in late March. That is huge. Okay, let's move to the hardware side and see how this all builds up. According to the input sources, we are facing an unprecedented AI memory supply crisis. The insatiable appetite for AI data centers has driven memory demand up an astonishing 600% over the past year alone. That is insane. Because production is almost entirely focused on this specialized memory, we're now seeing severe supply shortages for standard PCs and smartphones. As a result, tech giants are watching their materials costs absolutely skyrocket, which heavily squeezes their profit margins. Let's check in on market psychology to see how investors are reacting to all this. We use CNN's Fear and Greed Index to gauge the emotion driving the market. Currently, it sits at 63, which is still comfortably in greed territory. However, this actually represents a pretty significant pullback from recent extreme highs. The momentum is visibly cooling off as investors decide to take profits off the table rather than pushing valuations even higher amid all this uncertainty.
Underlying a lot of this market anxiety are intense geopolitical tensions and wild swings in energy prices. Various news commentary highlights that Brent crude has been fluctuating heavily around $107 to $110 a barrel. Interestingly, though, the immediate pressure eased slightly today when President Trump announced he is holding off on new strikes against Iran, following an appeal from Gulf leaders. While this prevented a massive spike in energy costs for the moment, the overarching uncertainty is keeping everyone on edge about future inflation. Section 1. The global bond yield threat. This might just be the single biggest structural threat to the equity rally right now, as borrowing costs soar. We are currently watching two totally opposing forces collide here. On one side, skyrocketing borrowing costs. The US 10-year Treasury yield is hovering right around 4.6%, a level that inherently makes borrowing incredibly expensive for growth companies. On the other side, high-flying tech and memory chip stocks are starting to struggle. When safe haven Treasury yields climb this high, investors logically question the risk of holding expensive speculative AI stocks. I mean, why take the massive risk when safe money pays out so well? And we really must remember this isn't just a US phenomenon. Let's dive into Japan, where we are witnessing a truly historic surge in government bond yields. The 10-year, 20-year, and 30-year yields are hitting multi-decade highs. We are talking levels we literally haven't seen since the 1990s. The 40-year yield is at its highest point since 2007. This massive global debt sell-off, compounded by the Japanese government planning a supplementary budget to handle commodity inflation, is sending absolute shockwaves through the broader markets. So, where are investors hiding their money? Well, we're observing a clear rotation out of the hottest AI and tech names and a strategic move into cyclical trades. For example, Japanese bank stocks are up around 3% as they benefit from these higher interest rates, alongside a surprisingly strong Japanese GDP print of 2.1% for the first quarter. Capital is clearly fleeing the stretched parts of the AI trade to find some comfort in traditional assets.
Section 2. Currency focus. Let's shift our attention to how key global pairs like USD/JPY and EURUSD are reacting to these intense macroeconomic shocks. 159.00. That is the absolute critical level for the USD/JPY pair right now. Despite Japanese yields soaring, the Japanese yen is under immense pressure, hovering dangerously close to this 159 mark against the US dollar. This is exactly the level we were at right before Japanese authorities initiated those suspected currency interventions during the Golden Week holiday.
Because U.S. yields are rising right alongside Japanese yields, there remains a very robust preference for the U.S. dollar, and this is creating a massive headache for authorities in Tokyo. There's a constantly growing risk of Bank of Japan intervention to prevent further currency depreciation. On top of that, if Japan sells U.S. treasuries to fund these interventions, it could ironically lead to even more weakness in the yen over time. It is a very, very precarious balancing act.
Briefly checking in on Europe, the EUR-USD pair is holding relatively steady right around the 1.1632 level. The broader market is currently digesting European trade balance data alongside overarching concerns about energy-driven inflation given the geopolitical backdrop. It's stable for the moment, but highly sensitive to any energy market shocks that might develop over the coming days.
Section 3, Upcoming Economic Schedule. Let's look ahead at the key data releases we should be paying attention to next. Referring to the economic calendar on investing.com for today, May 19, 2026, we have some absolutely crucial events lined up. At 05 a.m. U.S. time, we'll hear from U.S. Fed Governor Waller, which will be heavily scrutinized for any hints on future rate paths. Simultaneously, ECB Chief Economist Philip Lane will be speaking. Later tonight, at 2300 U.S. time, we'll get the critical UK Consumer Price Index data year over year. This inflation print will be a massive indicator for global central bank policy moving forward. So, as tech giants face supply squeezes and global bond yields offer a safe haven alternative, we have to ask, is this just a healthy market correction or the first major crack in the foundation of the AI revolution? Keep a close eye on those yields. This video is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Thanks for watching. Don't forget to like and subscribe.